All right, Dominic, Chu out on our markets desk with the latest on the Muni front. Well, now turning our eyes to D.C., my next guest says that Peter Diamond, a Nobel-Prize-winning economist and MIT professor, is not fit to be on the Federal Reserve Board. The Senate Banking Committee voted 16-7 last week to send Diamond's nomination to the full Senate. And joining me now from our Washington newsroom is Mark Calabria, the Director of Financial Regulation Studies at the Cato Institute. He's also a former senior aide on the Senate Banking Committee and was assistant to Richard Shelby, the ranking Republican on that panel. Well, Mark, you wrote an op-ed that we published today. It's available, by the way, for those of you who have a terminal. It's available on the terminal as well as on Bloomberg.com. You clearly do not think that he should be on the panel. Let's talk about he should be on the Federal Reserve Board. Let's talk about some of the technicalities here.
Sure. Well, and put aside his academic qualifications, the law is very clear that you cannot have more than one Federal Reserve governor from the same Federal Reserve district. Mr. Diamond is from Massachusetts. That's what the White House paperwork that was sent to the Senate said. But you already had a sitting governor, Dan Tarullo, is also from Massachusetts. That's what his paperwork has said. And some have argued that this is just a mere technicality, but I think it goes to the heart of the Federal Reserve system structure. After all, we have 12 banks. When the Federal Reserve System was set up, it was intended to have a system where there was fair representation across the country, also fair representation across occupations. For instance, the Act itself says you should have industrial, commercial, agricultural representation on the board. And if you put Mr. Diamond on the board, you have a situation where 4 of the 7 are former academics. And I will note there's no representation for academics mentioned in the Act. And I think in a broader point, we really do need to question, has this shift since the 60s where academics have come to dominate the Federal Reserve actually been a good thing for the Fed or a good thing for price stability? And the evidence to me doesn't indicate that it has been. So I think we need to get somebody who's actually had a real job, worked in the real world. And I don't think this is a minor technicality. I would be the first to say that there are 6 or 7 former nominees where the law has been violated. For instance, both Duke and Raskin, who are sitting governors, are both clearly from Richmond Federal Reserve District. So one of them is, in my opinion, serving in violation of the statute. So I think we need to get back to a fundamental respect for what the law says. For those who don't think that that section of the statute is important, then they should repeal it, and they should push for repeal. But I do think we need to get back to a point where we respect what the law says and we live within that.
Well, look, most people are going to say he's a Nobel laureate. What can possibly be bad about that? You point out that he's an academic. We should get someone who maybe is really run a business, but who out there is really capable? I mean, monetary policy is not something you do on the back of an envelope. At least I'd like to believe that's the case.
Well, you know, I would make the argument, it's important to keep in mind, it really wasn't until the 1960s that you even had the first PhD sitting on the Federal Reserve Board. And I'm a PhD in economics myself, so it pains me a little bit to say this. But the more and more you've added PhDs, and they have a staff of thousands of PhDs here at the board in Washington and the regional banks, and it doesn't really seem like the more economists we've added to it that you've gotten better policy outcomes. We actually had, in my opinion, fairly reasonable, informed monetary policy in the 50s, and you had no PhDs on the board. So my point is, and that's because I think that what the economics profession knows in terms of monetary policy has been grossly oversold.
How do you think that, Mark, how do you think having that many academics has skewed some of the decisions perhaps that have been made? And how do you think having non-academics on the board would have changed things?
Well, for starters, academics tend to approach things, and I think this is rightly, this is where their comparative advantage is. They try to approach things in simplifying and having a model of how they believe the world works. Now, with any model, you are abstracting away from real details of the world. Now, the argument would be that this model doesn't need to capture all those details because it gets the important points. And what I would argue is that the body of monetary policy, the body of models we have today, misses a whole lot of things. I mean, for instance, if you just look at the academic literature, you would conclude that anytime you lower the interest rates, you should have, at least in the short run, an increase in unemployment. Well, we've had essentially 0 interest rates over the last 2 years, and that hasn't worked. I mean, for instance, there's nothing in the models that would tell you that, well, hey, if you lend to banks at 0 and you let them buy treasuries at 3 or 4 yield, that they're not going to actually lend to anybody else but the government. So some of these institutional details, I think, are incredibly important. And after all, the importance of monetary policy is how does it impact the rest of us? And this isn't simply an academic debate.
Has he indicated which way he would vote on things? Is he in favor of QE2?
Well, I think he's in favor of QT. I don't think he's come out and said that exactly. And it's like a Supreme Court nominee. When they get before the Senate, they're very quiet about what their actual beliefs are. But I think it's pretty clear he's going to be a dove and he's going to be in favor of looser monetary policy.
All right. You're watching Bloomberg Fast Forward, and I'm Lisa Murphy, joined today by Mark Calabria from the Cato Institute. We were just talking about a piece, an op-ed piece that Mark published today on Bloomberg. It's available on Bloomberg.com as well. Mark, I just wanted to finish up one thought on Peter Diamond being nominated to the Federal Reserve Board. What a lot of people may not realize is that President Obama has sort of been in a unique position to have nominated so many of the voting members of the board.
He really has reshaped the board. If you counting Bernanke's reconfirmation with Diamond, that would make 5 of the 7 have actually been nominees from Obama. It's also worth observing that all of them are from coastal states and all of them are from states that Obama won. So if we really believe that there's a diversity of economic conditions and a diversity of insights across the country, we are ignoring a vast majority of the country in terms of, informing the debate at the Federal Reserve Board.
All right, Mark, let's move on now. Just close that topic and move to the next. Fannie and Freddie, you were on just, I think, a week ago talking to us about the housing finance system and what's broken with it. Well, Fannie and Freddie are 2 very large organizations established many decades ago with this mandate to expand home ownership. Now, both organizations nearly buckled under the weight of the mortgage mess back in 2008. And since then, taxpayers have doled out $135 billion in bailout funds. And depends on the analysts you look at, but it looks as if we could be on the hook for several $100 billion more before all is said and done with these 2 organizations. So let's talk about them. They still guarantee or own half of the country's residential mortgages. So that's more than $10 trillion worth, right? They own half of that. And many would argue that without them, we wouldn't have mortgage rates as low as they are today, and we wouldn't have such a high rate of home ownership. But is that logic flawed?
I think it is flawed. I mean, first of all, if you look at the first 30 years of Fannie being, quote, a private company from 1968 to 1996, the home ownership rate increased by 1 percentage point in 30 years of a private Fannie and Freddie. If that's increasing home ownership rate, then I'm fairly skeptical. I think it's also important to keep in mind the Federal Reserve itself has estimated that the impact from Freddie and Fannie is about 7 basis points. That's 7/100ths of a percentage point. That doesn't get anybody into a house who wouldn't be in one otherwise. Now, they did help create a secondary market. They helped create a securitization market for mortgages. I think that's there. We can build on it in many other ways. I mean, for instance, you can get a fixed-rate 10-year auto loan in this country that is securitized without a government guarantee. It's also worth noting that no other developed country in the world has a Freddie and Fannie. We only actually rank 17th in the world in terms of home ownership rates. A variety of countries, including Canada, and most of Europe have home ownership rates higher than the U.S., but they don't have the taxpayer standing behind the market. And I think that's an interesting thing. You don't see the rest of the world falling over themselves to recreate a Freddie and Fannie. In fact, they want to be moving in the opposite direction. So I do think ultimately we can move away from these sort of guarantees. We can move away from Freddie and Fannie. For the most part, I think as a society, we probably put too much capital on the housing, too much into mortgages. If you want to subsidize home ownership, subsidize home equity rather than home debt.
Mark, a number of people are worried that should these organizations go away, that there's a real effect in terms of home prices, that you're going to have a big impact on the economy as a result. And exactly how does this process work, and how much more is it going to cost taxpayers to get rid of the organizations?
Well, let's start with the latter part of it. I think we're easily going to put at least 400, maybe 500 billion into Freddie and Fannie before all is said and done. It's going to be a bigger question of how we actually recoup that. Now, I do think the question of how much of a transition period do you want, there's a lot else wrong, in my opinion, with our housing markets. But I think things such like FHA or the Federal Home Loan Banks, I think you can keep in place until you fix Freddie and Fannie to have that backstop. You already see the jumbo market starting to come back. So I think there's a variety of other essentially pillars of the housing market that can stand while you fix these 2 that can take up the slack.
All right, Mark. And what do you think about all the debt that they've issued? I know we don't have that much time now. I know there's a lot of foreign governments that own their debt. Oh, you know what, Mark? We're going to be right back.